All right, today we are breaking down a financial strategy that is, well, it's incredibly bold. Some people look at this and see pure genius. Others see a financial death wish. It all revolves around the stock SNDK, and let me just say, this is definitely not for beginners. Okay, let's jump right in.
And that quote really says it all, doesn't it? This is the big leagues. We're talking about a high-stakes game where the potential rewards are huge, precisely because the risks are, well, they're enormous. So what exactly is this play?
So, at its heart, the strategy is something called a short strangle. The easiest way to think about it is like this. You draw two lines in the sand, one way up high and one way down low. You're making a bet that a stock's price is going to stay between those two lines for a set amount of time. And just for taking on that risk, you get paid a fee right up front. That fee is called a premium. If the stock behaves and stays in the middle, you just keep the cash. Sounds simple, right? But the reality is anything but.
Okay, so let's get into the nitty-gritty of the specific trade that sparked this whole explainer. It's a massive bet on a very, very volatile stock, finding a moment of stability. Here are the numbers. The traders sold a put option, which is basically a bet on a price floor, way down at $350. They're betting the stock won't drop below that price by June. At the same time, they sold a call option. That's a bet on a price ceiling, all the way up at $1,000, betting it won't go above that price by September. Those are the two lines in the sand we were just talking about. And this, right here, is the whole point. This giant profit zone. Right now, the stock's trading at about $585, so it's sitting perfectly in that sweet spot. As long as the stock price stays inside this massive $650 range, the trade is a winner. But what happens if it doesn't?
And that question brings us to the best analogy for this entire strategy. You have to think of it like you're selling hurricane insurance. And to have any chance of surviving, you absolutely must have three things in place.
This quote just captures the danger perfectly. As the person selling this insurance, you collect a ton of money when the market is calm and the sun is shining. But if that hurricane, that massive, unexpected price move, actually hits, it becomes a full-blown financial catastrophe and fast.
So, what does it take to survive that kind of storm? Well, first, you need a massive amount of capital. If the stock moves against you, your broker is going to demand more cash, like right now, to cover the potential loss. That's a margin call. Second, you need serious psychological fortitude. You have to be able to watch your account swing by huge amounts in a single day and not freak out. And third, you need technical mastery. You have to know exactly what to do to manage the trade when it goes wrong.
And this right here is what separates the amateurs from the pros. An amateur sees the stock getting close to one of their lines and they panic. They sell for a huge loss. A professional, though, they see the same thing and they stay totally calm. They trust their plan and they execute a defensive move to stay in the game and fight another day. So, let's see what that actually looks like.
This is where that Grandmaster skill really comes into play. See, this is not a set-it-and-forget-it kind of trade. Not even close. It requires an active, detailed defensive playbook for the moment the market turns against you.
Okay, so scenario one. The stock absolutely takes off, soaring up towards that $1,000 ceiling. What do? First, the trader rolls up their bottom line. They buy back that now cheap $350 put and sell a new one much closer to the current price. This move collects more cash, more premium, which acts like defensive fuel to help absorb the losses happening on the other side. And if things get really hairy, they can roll up and out the call option, moving it to an even higher price and a later date just to buy themselves more time.
Now, what if the opposite happens and the stock crashes towards that 350 floor? Well, it's pretty much the same logic, just in reverse. They'll roll down that call option, moving the upper line closer to the action to collect more premium. They're essentially chasing the stock down to build a buffer against the losses on the put side. And if that 350 level really looks like it might break, they can roll that put option down and further out in time, creating more breathing room and more time for a rebound.
So if you boil it all down, this table is basically the playbook. Notice how every single action is a direct response to a specific move in the stock. The goal, always, is to collect more cash and buy more time, because in this strategy, time is your absolute best friend.
So you have the setup, you have the defensive playbook, but how does this thing actually end? Because with a strategy this extreme, there are really only two ways it can go.
And it really is that binary. You have the Goldilocks win. This is the dream scenario where the stock price is just right. It hangs out in that safe zone, time ticks by, and the options you sold slowly become worthless.
That means you get to keep all the premium you collected. The other outcome? It's a catastrophic loss. A huge, unexpected move can make your losses accelerate exponentially, and you could seriously risk a total account wipeout.
So what gets you that Goldilocks win? Well, first, just plain old price stability. Second is something called time decay, or theta. Think of it like a melting ice cube. Every single day that passes, the options you sold lose a little bit of their value, and that decay is a direct profit for you. And finally, you can win from a volatility crush. All that means is that if the overall fear in the market calms down, the insurance premium on these options just collapses, and you can close the trade for a nice, quick profit.
But the risks, man, they are just as powerful. First and most dangerous is gamma risk. This is the scary part. It means that as the stock gets closer and closer to one of your lines, your losses don't just grow, they accelerate. Think of a snowball rolling downhill, getting bigger and faster. Then you've got these outside factors. A meme stock event or some huge surprise announcement could send the stock soaring, and that can lead to, in theory, unlimited losses. And on the downside, something like a sudden supply glut in the chip market could cause the price to completely crash.
Which brings us right back to the central question here. After seeing the mechanics, the defenses, and the wildly different outcomes, what do you think? Is this a calculated, genius-level play on a volatile market? Or is it just an expert-level financial gamble where the risks are just too big to handle?
And in the end, we land right back where we started, with this one powerful idea. This is a strategy that pays you, and pays you well, for taking on a risk that almost nobody else wants. It's an absolute masterclass in risk management, but it's one where a single misstep can be the difference between a massive payday and a devastating financial hurricane.